Advanced technical analysis. Linear weighted moving average, WMA. The weighted moving average, known as WMA, is similar to the ordinary arithmetic average. The only difference between the two is that the WMA gives more weight to more recent periods than to more distant periods in time, in contrast to the simple arithmetic mean, which gives equal weight to all observations. For instance, a WMA over 20 days will give priority to the most recent 10 days. WMA acts as one of the strongest support resistance levels. The WMA is used as an addendum to other technical indicators. Exponential moving average, EMA. The EMA is similar to WMA, with the difference being that it gives exponential priority to recent periods. The most widely used EMA for short-term predictions are the 12-day and the 26-day EMA. For long-term predictions, 200-day EMA. The EMA is considered a refined version of the linear WMA, especially when markets are volatile. EMA is a strong resistance level. MACD. The moving average convergence divergence, MACD, is one of the most used technical indicators around the globe. MACD is calculated in a complicated way. It takes an EMA on the EMA. What is more important, the MACD crosses an indication line called a signal line. Sell and buy signals are considered more reliable if there has been a large swing or hump prior to the crossover. MACD is reliable only if the market is in a trend. When the MACD crosses its signal line from below, this is considered a buy signal. Arrows. If the MACD crosses the signal line from above, this is considered to be a sell signal. Momentum. Momentum is an indicator that provides a prediction of the relative strength and slope of a trend. If the momentum line crosses the zero line from below, then we have a buy signal. Conversely, if it crosses the zero line from above, then we have a sell signal. The higher the slope of the momentum line when it crosses the zero line, the steeper the trend will be. Momentum is of greatest usefulness when the market is generally bullish. Relative Strength Index. The Relative Strength Index, RSI, is a momentum indicator that attempts to measure whether an asset is overbought or oversold. It does that by comparing the magnitude of recent gains to the recent losses. The RSI can take values between 0 and 100. It is generally considered a rule of thumb that if the RSI approaches a value of 70, then the asset is overbought, and you should therefore take a short position and sell. If the RSI approaches 30, this means that the asset is oversold, hence we should take a long position and buy. If the RSI contradicts momentum, check a third indicator. Stochastic oscillator. Stochastic indicators go one step further than the oscillators we have described so far. Depict dynamics in price movement. The stochastic oscillator consists of two lines, %K and %D, and it can take values from 0 to 100. When %D is below the 20 threshold and %K crosses %D from below, %D is the red line, %K is the blue line, then we have a strong buy signal. When %D is above the 80 threshold and %K crosses %D from above, then we have a strong sell signal. Bollinger Bands. Bollinger Bands represent a channel of two lines formed by placing standard deviation of the price above and below the simple moving average line. As a rule, an asset is considered overbought when it touches the upper band, sell signal. Accordingly, an asset is considered oversold when it touches the lower band, buy signal. Williams Accumulation Distribution, WAD. The WAD is used to determine whether sellers or buyers prevail in the market. WAD is useful when there is a discrepancy between the price and market sentiment. Sometimes, even though the price might follow a rise-fall, the market sentiment can still be the opposite. If the WAD and the price move in opposite directions, then a trend reversal might soon take place. For example, if WAD is moving up and the price is going down, the price will most probably reverse its movement and go up as well.